welcome to our discussion on accounting. I'm extremely happy to be with you on your first day at IMI Bhubaneswar. I join your management in welcoming you all to IMI Bhubaneswar. I'm told this is your first day at IMI Bhubaneswar and this is the first session for 2 years journey of your MBA education. I would like to spend next 1 hour explaining and sharing and discussing with you about the role of accounting in management education. But before we do that, let me start by asking you, what is the subject matter of the management education? If you reflect on that question for some time, you'll see that management education deals with organizations. And if you are asked to name the organizations, in most of the B schools, I get these names: Infosys, Wipro, Reliance, ITC, Microsoft, and so on and so forth. Most of the B school students give the examples of organizations which belong to the joint stock companies. You may ask a question, are there any other forms of organization? Of course, yes. All these organizations are actually, as I mentioned, are statutory form registered under the Companies Act. What about your own institute? What about your institute? Let's say IMI. What about my institute, XIMB? What about Indian Railways? Or what about World Bank? These are not companies. So that means there are other forms of organizations too. And what are those other forms of organization? The forms of organizations can be sole proprietorship, partnership, joint stock company, society, cooperative societies, trusts, corporations, or government department. Let me give some examples somewhere. The shop outside on the way to your institute, a pawn shop, okay? Pawn shop on the way to your institute is owned by that pawn shop dealer, and he's the owner. He has put money, he is managing the business, he'll buy the goods, he'll sell the goods, he'll make profit. He's a sole proprietor. Whereas a partnership, his business is owned by two or more than two persons, okay, and is governed by Partnership Act 1932, okay. Whereas a joint stock company is owned by the shareholders. One, it is registered under the Companies Act, Companies Act 1956, and owned by the shareholders, large number of shareholders, okay. Just observe, think about, go to the website and find out how many shareholders are there, okay. So I'm giving you a question for you. Find the number of shareholders, shares and shareholders of some well-known companies of India. Okay, this you don't have to answer that now. Go to the library and check that answer later. Okay. Society is registered under the Societies Registration Act. Your IMI may be a society or a trust. XIMB is a society. Corporation is an interesting organization. It's set up, established under a separate act of the Parliament. okay, of the parliament. Let's say LIC maybe. It's not a company, so it's set up under a special act. It's not owned by the shareholder, it's owned by the government. And similarly, there's a government department like the Indian Railways, okay, so it's not a separate organization, it's a part of the government machinery. So Indian Railways, you see the budget of Indian Railways placed on the parliament, in the parliament. So the focus of our discussion, today's discussion, is of course joint stock company, and focus of your course in a business school is also about joint stock company. But in the process of understanding the companies, don't ignore the other forms of organizations. So whenever you see an organization, therefore certain questions should come to your mind. Number one, what is the form of organization? Okay, so when you see an organization, find out, is it a company or a society or a trust? Who is the owner of the organization? Okay, and who is the management? Who is managing the organization? Who is managing the organization? So these are the relevant questions, not necessarily for accounting. Have that question in the back of your mind whenever you see an organization. For example, suppose you pick up an organization because you are from Bhubaneswar. Let us take Nalco, which headquarters is Bhubaneswar. Who is the owner? What is the form? Who is the owner? Who is the management? Okay, these questions should come to your mind. So it is a joint stock company. Okay, it is registered under the Companies Act. The owners are the shareholders, of course. However, the Government of India, okay, Government of India is the largest shareholder. That is why it's called a public sector company. The management is with the board of directors. Okay, but think about IMI. IMI is not a firm, is not a company. It may be a society or a trust. Who is the owner of this? So it's the society members. Check who are the members. So no shareholders here. And the management is done by board of directors, but in this case we call board of governors. Okay, board of governors. So understanding an organization is to ask question about the form, about the ownership, about the management. And the form, ownership and management have a huge effect on accounting and finance. Let us go to the next question. As one of you asked, what are the features of a company form of org? There are several features which is given by the Companies Act, but I'm going to pick up only few of them and combine them together. And one of the most important features is the separation of the management. Is the separation of management from the ownership. That means the management and the ownership are in different hands, and that is one of the most important features of the company form of organization. Ownership is with the shareholder, but the management is with the board of directors. The ownership is with the shareholders. Some of the board of directors may be shareholders, or some of the shareholders may be board of director, but in principle, technically, these are two different bodies. The owners or the shareholders are called the principal, and the board of director is the agent of this principal. So this relationship leads to an important problem of management education, That's called the problem of agency, or the agency problem. What is that? Agent may not take decisions in the interest of the principal. Sometime there's a possibility that agent's action may not result in maximization of the wealth for the shareholder. And to compound that problem, there's one more. This is called information asymmetry. That means the agent will have more access, or access to more information, will have access to more information than the principal. So there is a possibility that the agent may not share every information. So this is one of the most important features, and this feature really drives the importance of accounting. So we expect, later on we'll develop that, it's expected that, so the management is expected to keep the shareholders informed about the decisions taken by them, and that happens through, that is reflected, okay, that is reflected through the financial statements. We'll come back to that statement a bit later. So now let us see the second, the other feature. The other feature, in fact, as I mentioned, I'm combining two another features: the limited liability of the shareholders and unlimited life of the company. What does that mean? The liability of the shareholders is limited. Let us take an example for that. See this balance sheet. So this balance sheet shows the assets of 130,000 and financed by capital, who is the owner, and the loan to the extent of 80,000 and 50,000 respectively. Suppose this company is closed now. Okay, suppose the company is closed and the assets are sold off. How much will the loan giver get? Okay, that's an important question. That if the business is closed, how much will the loan giver get? Now it depends on the value of the market value of the assets. Let us take one or two situations. If the market value is equal to 130,000, then the debt holders or the loan giver will get 80,000 and the capital, the shareholder, will get the balance 50,000. If the market value is 100,000, let me reduce it further. If the market value is 75,000, then the loan giver will get only 75,000. Okay, only 75,000. They cannot ask the shareholders. They cannot ask the shareholders to pay more. That is why it says the liability of the shareholders if the market value is 150,000, then the loan giver will get 80,000 and the shareholder will get higher amount, that is 70,000. So the liability of the shareholder is limited, but the upward cap on the liability is there, but there is no upward cap of the profit or the residual money that they will get. So there is every possibility that the shareholders will allow the management to take decisions which may expose the firm to higher risk. Therefore, debt holders are also interested. Therefore, the debt holders are also interested to know the effect of the business decisions taken by the management. Okay, so these two, the unlimited life, the companies, when I say unlimited life, the shareholders may come, unlimited life, the shareholders may come, shareholders may come and go, but the company stays. Okay, company stays unless it is liquidated. That's why it's an unlimited life. So to take the discussion forward, if you see, this brings the relevance of accounting. Both the shareholders and the debt holders have interest in understanding what the managements take decision, and the financial statements are the means through which both the debt holders and the shareholders get to understand the decisions taken by. What are these financial statements? The financial statements are the end product of financial accounting, and for us, financial accounting is a process of converting the business decisions into financial statements. Generally in a B school, we would like to understand the effect of the business decisions on the financial statement. So understand financial accounting more as a process of converting the business decisions into financial statements. So you need to understand, what are these business decisions? What are these financial statements? Business decisions, there can be several business decisions, right? However, the business decisions can be classified into all the business decisions that you'll come across, can be classified into financing decisions, investment decisions, or operating decision. Financing decision is a decision regarding the source of money. Source of money. We have seen that source is either owner's money or outsiders' money. Okay? Outsiders' money. So whether to finance the business with, which is also called equity, or whether to finance the business with debt. Investment decisions invariably result in acquisition of asset, and this is the day-to-day operations. Okay, day-to-day operations. So the business decisions can be classified into financing decisions, into investment decisions, and the operating decision. So whether you are studying finance or accounting, use this framework to see what decisions are. For example, the decision of Tata Steel to acquire Chorus is an investment decision, but that decision has an embedded financing decision. The decision you people have taken to do MBA is an investment decision, but how did you finance that? Your own money or a loan money is a financing decision. Now all these business decisions, let me just write down BD, all these business decisions will involve financial items. In other words, how will these business decisions appear in the financial statement? To understand that, I'll use another framework given by the conceptual framework of preparing the financial statement. All the financial items that you come across can be classified into incomes, expenses, assets, liabilities, and equity. So I'm saying all the business decisions, business decisions involve or affect, the financial items. That means the above financial items. Now you have to develop that ability to see the business decisions, understand the financial item, and all these financial items, appear in the financial statements. What are these financial statements? These financial statements are balance sheet, income statement, and the cash flow statement. Balance sheet shows the financial position on a particular date. Income statement will show financial performance for a period, and the cash flow statement will show the changes in the cash in hand. So this is if I put that in a model, it will look like this, that understanding accounting is understanding the business decisions, understanding the financial items, and observing the financial statement. That every business decision will have financial item, and every financial item will find a place in the financial statement. But this process of converting the business decisions into financial statement can be explained through the concept of accounting equation or the rules of debit and credit. The concept of debit and credit is generally used in an accounting classes at undergrad level. Here most of the B school use the framework of accounting equation. What is that? It shows that at any point of time the sources are equal to assets. Let us take a very simple example. Suppose we all start a business, we all start business, together started business, business with 10,000 rupees. So today when we have 10,000, so cash is 10,000, and we contributed that in the form of capital. So therefore capital on this particular moment is equal to the cash that I have. So therefore the sources are equal to the assets. Sources is the capital and the asset is cash. So sources are equal. And if you say that now I need some more money, and we took a loan after that, so took 20,000 loan from a bank, so cash will become 20,000. The capital is 10,000, but there is a loan, okay, loan of 10,000, and your equation tallies once again. Equation. So you have cash now 20,000. Now let's assume that you purchase stock. You want to buy some goods, okay? Purchase stock of goods for 15,000. Okay, what will happen now? So cash will come down and there will be a goods of 15,000 and cash will be 5,000. No change in the capital, no change in the loan. Again, the asset is equal to the source equal to the assets. Okay, and if now let me put the last transaction, goods sold for 30,000, entire goods. So goods will become 0, the cash will become 35,000, no change in the capital, no change in the loan, but a new item comes into picture, and that is called profit. The profit is 15,000 minus 13,000, so 15,000 is a profit. So equation tallies once again. So therefore, accounting equation says that at any particular point of time, the assets of the company will be equal to the corresponding sources. So in my understanding, understanding is understanding the accounting equation, understanding why the equation is changing and how is the equation changing. So as you move along during your classes, you will see accounting as a process of understanding the business decisions. So whenever you pick up a newspaper or a business periodical, check what decisions these companies are taking and then understand the effect on the financial statement. Thank you very much.